Welcome to the channel, everyone. This is Talking Sense. If this is your first time here, please hit that subscribe button. We are going to look through what's inside my tax-free savings account and why I have chosen these specific ETFs. Now, for those of you that are not familiar with a tax-free savings account, it was introduced in 2015 by the National Treasury. And the hope of setting this investment vehicle was to encourage South Africans to save and improve their financial savings. So it was there to help them or to promote a savings culture for the future. Now, there is a bit of the tax-free savings account is sort of ambiguous, and it's a little bit deceptive because most of us consider savings accounts as something we use in the short term for goals that are maybe two to 5 years away from now. So a lot of people have been using a tax-free savings account as just a way to store their extra money and not realizing the true benefits of this investment vehicle. So I think it's very important that we educate the people around us and let them know that even though it says tax-free savings account, it should be treated as a long-term investment vehicle. And personally, I use it as a vehicle that supplements my main retirement account. And one should be looking at least a 15-year period, because that's what it will take you to max out your 500,000 limit. So when the National Treasury introduced this tax-free savings account, they started with a threshold of 30,000 Rand per tax year. For those of you that are not sure, tax year is from the 1st of March to the following year, 28th of February. And then the 1st of March, the new tax year starts. So it's important to know that if you over contribute, then you will be penalized 40% on the amount you've over contributed. So like I mentioned earlier, it started off with 30,000 the first year, 2015, 2016, 30,000. And then the subsequent years after that, I think from about 2016, 17, somewhere around there, it was up to 33,000. And now we are currently at 36,000. And I think later on in the future, maybe 2, 3, 4 years from now, I think the government will increase it to maybe 39,000. Because at this point, no one has reached that threshold of that 500,000 limit. So I think when people get closer to that limit, they will increase the annual contribution. So let's have a look what's in my account and why I have chosen these specific ETFs. All right, so the first one that is still in my portfolio, if those of you have been subscribed to my YouTube channel for a while, you would know that this specific tax-free ETF I've been holding, and it is actually my largest holding within my tax-free account. I've got 3 ETFs in my tax-free account, and this one is the biggest weighting. It has the biggest weighting, so it's offered by Coreshares. And it's a global dividend paying ETF. The ticker code is GLODIV, GLODIV. Now, the main reason I've chosen them is because the constituents, the companies inside the ETF are very liquid. And they are strong companies that have been around for a long time, and most of them have increased their dividends consecutively year after year. So I like that they are very liquid. They are well-known businesses, and many of these companies have strong brands that we use on a day-to-day basis. I think there is about 109 constituents in total in the ETF. You can also see that they've got ETF holdings. So what that means is this is an ETF, but they've also got other ETFs within this ETF. So you are very diversified, and it's a global you have global exposure. It's 100% equity, all offshore, nothing exposed to South African markets. The portfolio aims to track the S&P Global Dividend Aristocrats Blend Index, and it tries as close as possible to track that. So let's have a look a little bit more inside of it, and we're going to look at some of the risks involved too. Now, before we get into the risks and who should be investing, I just want to break down the sectors that this ETF is invested in. You can see it's got a wide range of sectors, so you are very diversified. Industrials is the biggest sector. Consumer staples, these are things that we are buying every day. So it's a very resilient industry, and no matter what the economic cycle is, consumer staples are usually very resilient. It's things like food products we always need to eat. So these businesses have pricing power to some degree. Healthcare, financials, consumer discretionary. So you've got a diversified basket of sectors, as well as diversified across different countries. United States being the largest, 60%. So there is a little bit of concentration in there, but you can see you also have exposure to other countries like Australia, Germany, United Kingdom, China. All right. And it's completely 100% equity focused. So the asset allocation, all equity, small percentage of cash. Now, the main thing that you should be asking yourself is what's the performance like, and how are they going to perform going forward? So based on what we've seen, the constituents with inside the fund, the diversified sector, diversified across different countries, I would say over the long term, this ETF will continuously tick upwards like it has been. Nothing's guaranteed. Remember, past performance isn't always an indicator for future performance, but there is some degree of predictability, and it's also strong companies with inside of the ETF. So I think in the long term, you should be fine. Like I said earlier, this tax-free savings account or this specific ETF within it, your main objective is to hold long term. So if you're young and you're investing now, big drawdowns shouldn't really scare you. It's an opportunity to keep adding. And over the long term, 20, 30 years, if you're still invested in this specific fund within the tax-free savings account, then you will benefit in the long term, I believe. And this is why I've made it my core of my tax-free savings account. So on the right, we have the fund information, who is the market maker of it, who is the trustees and the custodians. So I won't go through all of it. I'll just highlight some of the key things that you should know. That the total expense ratio, although it's pretty steep, 0.64%, it's a little bit higher than others. Preferably, I like 0.3, 0.4, anything lower than that. But because the fund is performing, then they have that little premium. So over the long term, I think the fees might even come down, and I think they will continuously perform. You'll see that the annualized past portfolio performance is that on average, you make probably 18% a year. That's what the fund has been returning. It was listed in 2018 in February. That was the launch date. So it's 4 years in the making, hasn't even been 5 years. And in that 4-year period, it's returned 68%. Now that excludes the dividends. If the dividends were included, it would be a little bit more. So I think the dividend yield is around between 1 and 2%. Also nothing wow, but it's constant dividends. So the more your portfolio grows over time, the higher your dividends will climb. Now, there's just one thing I want to mention, that the tax-free savings account, we all know that dividends are tax-free, capital gains, capital appreciation once you dispose of an asset is tax-free, and also any interest earned is tax-free. However, there's one caveat to this, is that this fund is 100% exposed to offshore, which means the companies, the constituents within the ETF, they are in other jurisdictions. So as a South African and your tax-free account, you aren't exempt from paying tax in another country. It's not like because I have a tax-free savings account that I can bypass the laws of another country. So if you have foreign ETFs with constituents in other jurisdictions, you are still subject to the tax laws and the tax rates, the dividend tax of that specific jurisdiction. So although I have this ETF in my tax-free savings account, I will still be charged dividends tax on these foreign companies. So to truly maximize your tax-free savings account, you want to have maybe a diversified ETF portfolio within your tax-free. So if you truly want to benefit from the tax-free aspect of it, you're going to buy an ETF where the underlying constituents, the companies inside, are all South African-based companies. Because when they pay tax, then you won't pay any dividends tax on that. So we'll have a look. I have one of them in my portfolio. I'm going to show you the pros and the cons to that. But I like this. This is the core of my portfolio. It gets about between 50 and 60% of my annual allowance. So it gets between 18,000 and up to between 18 and 22,000. That's my contribution to this fund every year. Now, why do you choose this fund? You choose it specifically because you get global exposure to quality companies that are very liquid. When I mean liquid, it's the asking and the selling price. Normally, when you place buys or sells on the ETFs, it might show you a buy price of 12 Rand, but a sell price of 11.20. So there's that big spread in between. And so it's important to have liquid quality companies in a fund that has capital inside of it, because sometimes the price you see is not always the price you get. So some of the benefits are the global exposure to quality companies, Rand hedge diversification, because it's exposed to foreign companies or foreign jurisdictions, countries. If the Rand gets weaker or depreciates, you have that natural hedge. So if the Rand depreciates, the equity price or the price of the ETF should slowly climb. And if the underlying companies inside also benefit or do well, then your growth is even higher. Global inflation hedge, which is what I like. Inflation is picking up. So that's very important. It's one to consider. And it's fairly cost effective. This is taken from their fund sheet. So cost effective, they could be a little bit cheaper, but like I said, they are performing. So someone that's got a premium on price, but they are performing, then you can justify the price. Now, obviously, with every investment, there are some risks. So there are risks with this investment too. One of the main ones is that it's holding foreign securities. So you as a foreigner, you don't have much say over your assets or your investment in other jurisdictions. So you have tax aspects to it that you can't bypass or avoid, settlement risks, foreign exchange risks. Maybe the Rand appreciates and doesn't depreciate. Then obviously your Rand hedge is working against you in the other direction. So that is a risk. And there are other risks on the screen, so you can see it. I've mentioned some of them, but I don't want to take too long in this video, so let's keep it going. I will also attach the fund fact sheets in the description in the YouTube video, where you can download it and spend some more time going through it. The second ETF that I have in my tax-free savings account, I recently came across it on Twitter, thanks to Finance Ghost. He shared this, and I decided to sell my Signia Health ETF to get exposure to this, especially now that the US markets are sort of deleveraging, which means the prices are coming down because that bubble is deflating. which works out good because I've got a little bit of cash in my tax-free savings account. I trade sometimes, but I'll speak about that shortly. And anyway, it might coincide with our new tax year, which starts on the 1st of March. So all our allowances will restart to 36,000 again, which means we might be able to take advantage of these massive dips that are happening in the US markets. And we have liquid cash and we might be able to buy these ETFs a little bit cheaper. So this is why I like this account and why I'm keeping an eye on it. I have put some money into it at the moment, and I'm slowly buying in price dips. The reason I like it is because it's quality companies and it's high growth companies that have proven themselves. They are not going to go anywhere, in my opinion. I think they will accelerate in the future. High growth. Again, this one is completely focused offshore on foreign equity, 100%. Got a little bit of foreign cash. So it's also a rand hedge, rather. So if the rand depreciates, this ETF will pick up over time too. And you can see some of the constituents within this fund, which is One Invest, the S&P 500 Infotech Index Feeder ETF. So I like it a lot. You can see the highest holding is Apple, 22%. So it's got a very large weighting to two stocks there, Apple and Microsoft, which is accounting for just over 40%, close to 50%, which is some concentration risk. So if there is a general pullback or a market scare or correction because of these high flying multiples in these stocks, you may see that this specific ETF underperforms for the next year, possibly two, and might take a year or 2 or 3 years to recover. But that's a good opportunity for us as investors to buy at a cheaper price, and we are buying quality. Most of these companies, if not all of them, are all profitable, making cash, unlike many other growth stocks that are going to make cash on a promise. These ones are actually making cash, growing their margins. So I like it for that. Quality companies, offshore exposure. The fund has been phenomenal. I think it also listed in March 2008. Yes, Class A launch 7th of March 2018. And I think, if I'm not mistaken, on Friday, 11th of March, it closed just over 14, close to 15, I think. But in that time, over the 4 years, it's returned over 200%. So that is phenomenal. That's very good growth. You can see that it's the year-to-date returns, and it's been delivering over 40% a year for the last 3 years. Now, can that continue? I don't think we might see those kind of returns this year. I could be wrong, especially if the markets pull back. So you could see a drawdown of up to 25, 30, 35%, which is normal. That's those cycles. But over the long term, quality companies, they'll make more reinvestments. They have pricing power. They will grow. And I think this is also a very good long-term one. So keep an eye on it. As long as you understand that this is a high risk investment and you shouldn't hold it for less than 5 years. Because like I said, you might buy this tax year, let's say with your full amount, 36,000, and then you experience a 35% correction for the next year or two. So if you sell out, then you're going to lose that money. So that's why it's recommended for 5 years, because it's high risk. They know that these things go up and down like this. So you have a pullback now of 30% and it stays flat for another year or two, and then it starts climbing up again. So you might only get in on year 3, 4, 5 where you see any meaningful gains, but the gain in 1 year you can see has the potential to go between 40 and 100%. So those that can stomach volatility, stomach risk, understand the risk, this is a good option. I like it. It's very attractive, and I like that the US stocks are pulling back, because it's going to give us an opportunity to buy lower. The fees are also much better. You can see total expense is 0.35%, which is fantastic. Low fees, high returns. You can't complain as an investor. Again, let's see some of the risks that you should identify. This is a very concentrated ETF. It's focused on one sector entirely, and that's the information technology. So you've got no diversification. You're exposed to one geography, like one area and one sector. So you've got a concentrated risk, you've got volatility, you've got company risk, you've got sector specific risk, country risk, exchange risk, economic and political risk. So it's very aggressive, the risk. And if you are going to battle sleeping at night, or you're going to worry about your investment, then I wouldn't recommend this. If you're young and you've got time on your hands, this is a very good opportunity and one that most people should potentially consider. Who should consider investing in this? I won't go through all of them, but you can pause the video, you can read through it. Like I said, I'll also attach the fund fact sheet below, but it's mainly for those investors who are seeking equities like US technology equities. You want exposure to that. Low cost fund, saving you on fees. And the third one, which is also a Coreshare ETF, preference share exchange traded fund. So this specific ETF is 100% concentrated to South African shares. Now, the reason I emphasize that is because we know tax-free savings accounts are tax-free. That's the selling point, but not for foreign ETFs. Whereas this ETF is South African, so any dividends paid to you are truly tax-free. So now you are truly maximizing that benefit of having this account. So you have to weigh up the pros and cons. I will show you now why I think you need to have this, but why you also maybe shouldn't have it. So the dividends isn't just a reason to go and buy this. They are juicy dividends, and they pay quarterly, which is every quarter, every 3 months, you are going to get dividends. And the dividend yield, the last time I checked, it was sitting on about between 8 and 10%. So it's a high dividend yield. But the problem I noticed with this is that the ETF underperforms. When I was looking at the numbers, excluding the dividends, right? I haven't added the dividends into this, but the return from when they listed in December 2013 to now was negative 7%, between 7 and 8%. So I haven't added the dividends, so that's not total return, but just on the share appreciation, it goes up and down, flat, sideways, negative 7% in 9 years. So if you were basing your decision of investing in this for the dividends to not pay tax, that's great. You're not paying tax on the dividends, but you're not benefiting from any capital appreciation. So why not opt for a foreign ETF where you're getting that 40% capital appreciation, but dividends might still be taxed, or no dividends? So you have to weigh up the benefits, consider which one is better, or diversify across 1, 2, or 3. All right, so the main objective of this specific fund, the Coreshares Preference Share Exchange Traded Fund, it tracks the JSE Preference Share Index, and it buys constituent securities in the same weighting which are included in the index. All right, so you'll see some of the constituents. There's a lot of banking shares in there: Standard Bank, ABSA, First Rand. Between those 3 banks, you've got 65, almost 70%. Now, you could question yourself and say this ETF might see some gains as interest rates start rising. So the profits of banks may increase from higher interest rates. But at the same time, they might have higher debts that aren't repaid. So their faulty debts, their loan books might not get what's promised. So there's that risk that they don't get the income that they are relying on because there's pressure in the economy. People might not be able to pay their debt back. So, and you saw in this, in the banking shares also didn't pay dividends when the pandemic hit over 2020. They suspended dividends for a while. So again, there's risk, there's that concentration risk. And it's not, shouldn't solely be dependent on, oh, it's a high dividend payer and it's tax-free. But that is a selling point. But you just have to weigh up the pros and cons. You'll see that they listed in 2013, like I said, the original price was 10.87 and currently they are on about 10 Rand. So that's an 8% loss in those 9-10 years. All right. So since inception, they say it's worked out to be 8.6% a year. There's obviously included the dividends. So with the dividend repayments and reinvesting, then your total return wouldn't have been negative. It would have only been about 8% a year. So if you're including the dividends and you're reinvesting, then your return can actually be positive. And who knows, this might be in a cycle where it actually goes up and doesn't fall. But like I said earlier, it's concentrated to the local economy. So whatever local risk there is will affect our local shares, which would negatively affect this ETF. And it's in the banking sector. The total expense ratio, also 0.56. It's fair, but also a little bit on the steep side. I like anything 0.4 and below, like I mentioned earlier. And that's an option. Now, before I end the video, let's just talk about why you would choose this fund and some risks. The main reason is the attractive yield, which is that income coming in. It's tax efficient if you're holding it in your tax-free account. You get quarterly distributions. It means every 3 months you're getting paid dividends. Cost effective. Most of these funds say that. They can be a bit biased. Accessible, transparent, useful asset allocation tool for investors. Some of the risks, you can see index tracking risk. The ETF's return may not match the index return due to operating costs. So on the one hand, you have cost effective, and on the other hand, it may not reach its returns because of operating costs. Means the fund is underperforming, but they're still taking their fees. So if you think they deserve their fees for underperforming, then you can invest your money. An investment in the ETF involves risks similar to those of investing in any fund or ETF, such as liquidity risk and capital risk. That's just saying know your risk. There's a chance of you losing money, drawdowns, and liquidity issues if there's redemptions. When people are pulling their money out or the banking sector is doing bad, etc., etc. Now, before I end the video, this might be a bit unorthodox for some people, but I use my tax-free savings account for trading too. Now, the first two ETFs that I showed you, the Coreshares Dividend ETF and the Info S&P 500 Tech Index, those two are going to be my long-term holds. All right, this one I plan to buy the dips. The first one is where I just continue accumulating. Buy the dips in this one, buy in the long term. But one like this, the Coreshares Preference Share Exchange Traded Fund, is something I would trade. Now, the price started at 10 Rand when it listed in 2013. I think it got up to about a high of 11, fell down to 8, 7 multiple times, recovered to 10, pandemic hit, fell down to about 6 or 7. So shares like these, I would look to trade. There are other ETFs where I would trade. Like I said, I bought Signia when it came out, the healthcare ETF. Bought it at about 24, sold it about 26, 27. Took that profits, put it into my long-term holding. I don't pay tax on that. And as long as I don't withdraw the money out of my tax-free savings account, I can buy and sell multiple ETFs multiple times if I would want to. Now, some people wouldn't recommend doing that. I wouldn't recommend doing it too often, but there are opportunities where I could buy an ETF, sell it, take the profit, and maybe it coincides with a big market dip where I take all that profit and I put it into my long-term holding. So I do that. I'm not a market timer. I know you can get burnt. The long term, at the end, you should be buying and holding quality. But like pre-tax that we saw, you've been holding for 9 years and the price have gone nowhere. So buying and holding is a strategy, but buying and holding and forgetting is not a strategy. So it's important to weigh up who you are and what you want to do. So my breakdown is as follows. GloDiv, the global dividend one with the liquid paying companies, and global offshore, that constitutes 60% of my holdings, between 50 and 60%. Reason I like it is stable, offers a small income. It's the core of my portfolio and it offers offshore exposure. Liquid companies, I can get in and out fairly quickly if needed to be. And then I've taken the S&P 500 Infotech ETF, ETF5IT, and that is going to be built to about 30% of my tax-free portfolio. And the reason I like that is because it's high growth exposure, also offshore exposure, and the returns are quite decent, and the fees are, I think, are truly cost effective. And then the final one is the preference shares, which I sell, buy in and out. I trade 10% of my funds, so about between 4,000 and 5,000 Rand of my annual allowance that goes to trading in and out of shares, maybe making a few extra bucks or extra few thousands, flushing that money into my long-term holdings. But ultimately, I'll end with 2 ETFs, which is GloDiv and the ETF5IT. And eventually dispose of the preference shares one. I just try and time the dividends, take the dividends, put them into my long-term holdings. All right, that's the end of the video. Thank you for listening to the end. And let me know in the comment section what you think of these ETFs, or let me know which ones you are holding and why you are holding. All right, thanks again. And if you haven't hit subscribe, please hit subscribe so you can stay up to date with my latest videos. And I will see you all in the next video. Bye for now.